It's a Tuesday morning in Lyon. You're sitting at your kitchen table, coffee going cold. Phone face up beside the croissant you haven't touched. You open your banking app. The number staring back at you is 100,000 euros. And the question that's been living rent-free in your head for weeks finally lands with full weight. What do I actually do with this? Do you put it in the market, let it compound quietly for 20 years while you sleep, or do you use it as a lever, buy a property worth 4 or 5 times that amount, and let someone else's rent check build your wealth? This is France's great financial debate. And most people get it completely wrong, not because they're not smart, but because they're comparing two things using the wrong ruler. Today, we're settling it with real numbers. Let's start with the stock market, because most people in France dramatically underestimate what it can actually do for them. The CAC 40, France's benchmark index of the country's 40 largest listed companies, has delivered an annualized total return, including dividends, of approximately 7 to 8% per year over the long run. That's companies like LVMH, Total Energies, BNP Paribas, Airbus. Blue chips that sell products to the entire planet. But here's the part that turns a good investment into a genuinely powerful one. And this is the piece that almost nobody talks about at dinner parties or in the financial press. France has one of the most generous tax-sheltered investment accounts in all of Europe. It's called the PEA, the Plan d'Épargne en Actions. And if you don't already have one, stop this video and open one today. Here's how it works. You invest up to 150,000 euros inside a PEA in European company shares or funds. You leave that money untouched for 5 years. And after those 5 years, every euro of capital gain, every dividend, every reinvested return, completely exempt from income tax. You still pay the 17.2% social charges on withdrawal, but you sidestep the standard 12.8% income tax component entirely. On a long compounding journey, that is not a small detail. That is a fundamentally different outcome. So let's run the numbers. 100,000 euros invested in a diversified CAC 40 index tracker inside a PEA, compounding at 7.5% per year for 10 years. You're looking at approximately 206,000 euros. Stretch that to 20 years, and the same logic produces around 424,000 euros. From a single decision made once on a Tuesday morning with cold coffee. Now, add the habit that turns good investors into great ones. You drip feed an additional 400 euros per month into that same PEA. You don't think about it, you don't touch it, you automate it. Over 20 years at 7.5%, that extra contribution compounds to roughly 250,000 euros on top of your original capital. You're now looking at something north of 670,000 euros. That is not theoretical wealth. That is a retirement that you designed. And while that machine is running, you have 0 phone calls about broken boilers, 0 arguments with tenants, 0 emergency repairs at 11 at night on a Saturday in February. But now we flip the board entirely. Because property investors in France have access to something that stock investors simply cannot easily replicate. It's leverage. Borrowed money at scale. And this is where the comparison stops being a fair fight. With 100,000 euros, you don't buy a 100,000 euro property. You use it as a deposit and buy something worth 400,000 to 500,000 euros. The bank lends you the rest. Suddenly, your 100,000 euros is controlling an asset worth 5 times its value. French residential property has historically grown at around 4 to 5% per year on average nationally, though the number varies enormously depending on where you buy, and we'll come back to that in a moment. That sounds lower than the stock market, doesn't it? But hold on. That 4 to 5% is not growing on your 100,000 euros. It's growing on the full 450,000 euro asset. Let's do the maths visibly, right here on screen. A 5% increase in year 1 on a 450,000 euro property adds 22,500 euros to your net worth. Your actual cash invested was 100,000 euros. That is a 22.5% return on the money you put in. The stock market would need to have a very strong year to match that on the same starting capital. Take a 3-bedroom apartment in Bordeaux or Rennes. cities that have seen property price growth of 30 to 38% over the past 10 years, according to Notaires de France data. A €450,000 property purchased in a well-connected growth corridor today, growing at 4.5% annually, is worth approximately €703,000 in 10 years. Subtract your remaining loan balance, and you've built an equity position that your €100,000 stock investment, working hard on its own, would struggle to match over the same period. And if you've been renting it out the whole time, gross rental yields across French regional cities currently sit between 3.9 and 5.1%, according to Catella's latest market data. On a €450,000 property, that's between €17,500 and €23,000 per year in gross rent before expenses. That is a second income stream running in parallel with your capital appreciation. Now here is the thing that almost nobody puts in their comparison, the thing that changes the entire shape of a calculation. The hidden entry cost of French property is not small. It is brutal. When you buy a resale property in France, you don't just hand over the deposit. You pay the frais de notaire, the notaire's fees and transfer taxes, which, for an existing property, typically run between 7 and 8% of the purchase price. Some departments raised that rate in April 2025 as part of the national budget reform. Let's do that maths right now. On a €450,000 property purchase, 7.5% in notaire fees is €33,750. Gone before you own a single brick. Then add loan arrangement fees, a home inspection, property insurance, and potentially a rental management agency fee if you're not self-managing. Your €100,000 deposit does not go entirely toward the asset. A meaningful slice of it disappears before settlement day. With a PEA, your entry cost is effectively zero. Open an account online with a bank like BNP Paribas, Société Générale, or a digital broker. No minimum, no transfer tax, no notaire. Your full €100,000 starts compounding on day one. That doesn't mean property loses the argument, but it means the starting line is not equal. If you're comparing honestly, you need to account for the fact that your effective invested capital in property is closer to €66,000 of appreciating equity, not $100,000, once entry costs are stripped out. And this is where geography matters more than almost any other factor. France is not one property market. It is 30 different ones wearing the same flag. Paris is still the prestige asset, €9,420 per square meter on average in 2025. A two-bedroom apartment in the 15th arrondissement will cost you €700,000. The entry costs alone on that purchase would eat €50,000 or more. Gross rental yields in the capital currently sit around 3.9%. Paris is a long-game capital preservation play. It is not a cash flow investment. Go 400 kilometers south to Toulouse or 500 kilometers west to Rennes, and a different conversation begins. In Toulouse, average property prices sit around €3,200 per square meter. A comparable two-bedroom apartment costs €220,000 to €260,000. Gross yields climb to 4.5 to 5%. Demand is driven by a young, growing population anchored to Airbus, the aerospace cluster, and 3 major universities. That is a fundamentally different risk profile. The leverage works harder, the yield is stronger, and the entry costs are a smaller percentage of total return. This geographic divide is the insider truth that the property headlines in France consistently fail to communicate. The question is never simply, should I buy property? The question is where, at what yield, and with what leverage ratio. Now here is the fear moment. Because there is one coming for both strategies, and you need to know it before you commit. Average French mortgage rates on a 20-year fixed loan currently sit around 3.23%, according to December 2025 Banque de France data. That is not a catastrophic number. It is manageable, but it is significantly higher than the near-zero rates that defined the 2016 to 2022 window that created a generation of property millionaires. Borrowing conditions are tighter. Banks require stable employment, a clean debt-to-income ratio below 35%, and typically 15 to 20% down. The era of near-free leverage is behind us. For stocks, here is the equivalent fear. The CAC 40 fell 58% between 2007 and 2009. Anyone who panic sold during that window locked in permanent losses. Behavioral finance research tells us that the average investor consistently underperforms the index they're invested in, not because the fund is bad, but because human emotion gets in the way. One dramatic headline, one sleepless night, one impulsive sale, and 20 years of compounding gets erased in a morning. You cannot panic sell an apartment at 3 in the morning because global markets dipped. That forced holding is both property's greatest weakness and its greatest psychological protection. The mortgage is a commitment device that removes the option to be stupid at the worst possible moment. So here is the honest answer to France's €100,000 question. If you want simplicity, flexibility, and the ability to start today with zero bureaucracy, open a PEA, put your €100,000 into a low-cost CAC 40 or European index tracker. Automate a monthly contribution of whatever you can manage, and let time do the only work it has ever reliably done. 20 years from now, you will not regret that decision. If you want to use the bank's money to multiply your returns, and you're prepared to absorb the entry costs, manage the ongoing complexity, and choose the right city in the right corridor, not Paris for yield, but Toulouse, Rennes, Nantes, or Bordeaux for growth and cash flow, then property can deliver returns that the stock market, on the same starting capital, mathematically cannot match. But the families who build lasting wealth in France do not choose one or the other. They build a PEA for compounding and liquidity, and they use leverage to build a property portfolio alongside it. Two engines, different fuels, pulling in the same direction. Wealth in France is not about finding the right asset. It is about understanding which tool fits which moment in your life, and having the patience to let both run. If this changed how you think about your money, subscribe to the channel. This is what real financial education looks like. No jargon, no nonsense, just the numbers that actually matter.